We are going to practice how to create income statement uh, by the absorption approach and contribution approach so that we can identify how this decision model affects these two different types of decision model will affect this special order accept or reject. Part 1, decision models by absorption and contribution. Kodak Corporation gets a special order for Branson Company at 26 per unit for 100,000 units of seat covers. Kodak is currently selling the seat covers at $40 per unit. $40 unit is selling price at this at the current time, but $26, can you accept this $26? And producing them at $30 per unit of total manufacturing cost, the cost of goods sold, the manufacturing cost, including fixed and variable based on absorption approach. It's so clear, too obvious, because $26 is lower than the $30, the cost of goods sold, the manufacturing cost, including fixed and variable, everything. So we can create this income statement here. Unit, it is segmented by $1 million a unit at selling price $40. This part is already have information, and this part is additional, the special order 100,000 unit price $26, and then that part is total. So $26 and 100,000 unit total price is, we just multiple 100,000. So total order 1,100,000 unit, including the special the order is just to sum up this selling, the sales, and then the less manufacturing cost. Manufacturing cost is $30 minus $30. Then also this $30 times 100,000 units. And then let's sum up these two manufacturing cost of goods sold. And then just to sum up these two, let's drag. So we got this answer, $400,000 loss if we get this special order. $400,000 is going to be reducing this gross margin from $10,000 to $9,600,000. So definitely we are not taking this $26 special order 100,000 units. And less and administrative variable and fixed is not relevant under this information. So the $4 in operating income, we get the same result. And then here we get this amount in total, $8 million. So the operating income is $1,600,000. So we don't accept, definitely we don't accept this $26, which is lower than the variable cost, the manufacturing cost of goods sold, because now the operating income has been reduced if we accept this. But the problem of this absorption approach is not identifying the variable cost and the fixed cost. If we segregate this variable cost and fixed cost with the manufacturing and selling and administrative, we will have some different result. For example, however, the special order would neither affect total fixed cost nor require any additional variable and selling and administrative expenses, which are irrelevant to the special order. We have the specific information to create this contribution approach. Variable manufacturing cost per unit and variable selling and administrative the price per unit, and the fixed manufacturing and fixed selling and administrative. Now we have all this variable and fixed cost information, so that we can identify if this special order can be accepted or rejected based on the contribution margin result. So the sales price again $26, and then we take this order. How many? 100,000. So total sales is just the sum of these two. Now let's variable manufacturing cost. Now we are not following this absorption approach. Absorption approach gathers all the variable and fixed costs for manufacturing or production. But now, regardless of what kind of activities, we gathers all the variable cost, because variable cost usually have the very similar the cost behavior, but not in this case. The variable manufacturing 24, so we put 24, and then $24 times 100,000, the special unit, and then we can just sum up. And then variable selling and administrative, the usual when we produce the special order. So selling and administrative expense is not relevant. It's not relevant. It's irrelevant information. Also, as indicated in the question here, the special order neither affect the total fixed cost nor require any additional variable selling and administrative expense, which are irrelevant. So we do not increase any variable selling and administrative expense, so it is irrelevant for this special order. So we just get the variable selling and administrative from existing. Then the variable cost is now the same for this special order. And then let's sum up these two to get the total order 1.1 million units, including special order. So 28,600. Then finally, the special order price $26 per unit minus this variable cost $24. Now contribution margin is $2. As long as this special order still create the contribution margin, then we can accept this order, even though this $26 is very low selling price comparing the $40 existing selling price. We can still accept if we have the idle capacity. Definitely we can receive this order. So the total contribution margin, including this special order, now is increased to $14 million from 13,800 contribution margin. Now we increase 200,000 more, right? And then fixed costs also are irrelevant to the special order, so we do not increase any of this here. So the total amount is exactly same as this fixed cost. The same as this fixed cost. So let's sum up. Let's sum up this total amount. So as you can see, what's that? Oh, this is the fixed cost, not the sum of everything. Equal 14 million plus 11.800,000. Okay, so $2,200,000 operating income. Now you can see that it is increased. So we can accept this the special order that makes a contribution $200,000. That's why we call it the contribution approach. We gathers only the variable cost, so that here which cost is relevant and irrelevant to make this special order decision. So you can see this the differences between the absorption approach and contribution approach. So next video clip we will cover this part 2 with activity-based costing for special order. See you in the next video clip.